Silver did hit its intraday all-time high of around $50.36, January 18th, 1980, and it was there for a very short time. Most that we can determine is minutes. Some of the floor traders think maybe up to an hour. So I'm going to stay in that range, but no longer than an hour from everything I can determine. I know it was intraday. So it briefly touched the $50 mark due to the Hunt brothers buying and a speculative frenzy that was taking place.
The Morgan Report with David Morgan. Discover how to build and protect your wealth at themorganreport.com.
David Morgan of themorganreport.com. Well, I'm actually at the Money Show in Las Vegas, and I'll be speaking again tomorrow. But I wanted to get this weekly perspective. I decided to talk about this $50 silver price in 1980 and put it in proper context, because I think there's a great deal of the silver community that actually don't realize what took place and how long silver was at $50. So silver did hit its intraday all-time high of around $50.36, January 18th, 1980, and it was there for a very short time. Most that we can determine is minutes. Some of the floor traders think maybe up to an hour. So I'm going to stay in that range, but no longer than an hour from everything I can determine. I know it was intraday. So it briefly touched the $50 mark due to the Hunt brothers buying and a speculative frenzy that was taking place in basically the whole month of January. January 21st was Martin Luther King Day, and the market was closed. And then January 22nd, 1980, when the market reopened, silver crashed hard, falling 20% that day. From there, the prices continued to plummet as the regulators had changed the margin requirements and basically had sell-only orders. Summary is it wasn't in multiple days. The market was incredibly volatile. Margin requirements were increasing, and regulators were intervening. The rapid price spike to $50 was a speculative blow-off top, not a sustainable price level. Key facts. The COMEX was, this says 50.36, as I mentioned at the beginning. The London fix was posted at 49.45 the same day, and the Chicago Board of Trade's intraday peak was 52.80 on January 18th. By the end of the day, it had retreated, and the daily COMEX close was about 46.80. Throw the chart in from the last peak in the last day of April 2011. And from this chart, you can see it was 48.58. So again, we never hit 50 on a close basis. And the context and aftermath. So COMEX imposed Rule 7 on January 7th, increasing margin requirements intended to curb speculative excess, and this did help precipitate a swift price reversal. Within days, it dropped 20%, and a deeper crash occurred on Silver Thursday, which is March 27th, 1980. There's a link to Wikipedia. You can look it up on Wikipedia if you want to read more about it, Silver Thursday. So the takeaway to me is that using the $50 plus intraday silver peak on the 18th of January 1980, as short-lived as it was, lasting probably only minutes before the market reversed, needs to be put into context. So if you look at the silver market from a longer-term perspective, you would see that the 1980 average price was $20 per ounce. So I think that is actually a fairer price to use as a high rather than an intraday spike. I have very often said in many of my interviews that one day doesn't make a market. In fact, a lot of technicians that use price will throw out the highest and the lowest and get rid of those and then do an average from there. So the idea that I would use maybe to get maybe a more accurate idea would be to use the average price of 1980 of $20, or you could round it up to 25 and use that maybe as a price basis rather than basically a momentary price. Not saying it didn't reach that level, it did. How many contracts were traded there? Well, it was only minutes, believe me, it's few. And having the history in silver that I have, what a lot of people don't know, and I've said this on shows in the distant past and have not said it recently, that on Sepulveda Boulevard in Los Angeles, there were in those days, probably in the 79, 80, there might have been 10 gold and silver dealers just on that one long street. Regardless, the point is that on that day of January 18th at $50, and of course, they don't have the internet connections and Bloomberg terminals and all that, but the communications at the time was showing 50, and the dealers were paying 35. They bid back that $15 spread just to protect themselves. There were very few coin dealers in the country that were giving you that price. And again, it didn't close there, although it closed in different markets. I showed you what the NYMEX was closed at the CBOT and the London market. So that is it. I'm going to leave it there. You can make up your own mind what's valid or invalid or how you want to measure it. I think the best way to measure it is against other goods and services. What's an ounce of silver buy? And I think using more of a basis as far as a sustained price or price level would be more accurate. I mean, that's kind of the argument on Bitcoin. It's so volatile. How can you really price anything? It changes so drastically. Well, here's an instance where silver was doing that. So you're going to take that little bitty part of history and use that as a basis, as like a sustained level. It wasn't. So again, I'm not bashing silver. I'm probably still one of the biggest silver bulls out there. And I'll go on record. I think I'm the first one to predict triple-digit silver. Certainly, I'm not the only one these days. There's others that are looking at, 4-digit silver. Well, before we get there, we do have to get through 50 and sustain it. But I think that I predicted $100 silver or more in my first book in 2003. So certainly I'm still bullish. I think silver is going higher, but I also want to put the $50 high mark. So I want to put it into context. You can make up your own mind, use whatever price you want. You can project whatever you want, however you want. But as far as I'm concerned, I think if you use 25, 1980 price, and then project it from there on whatever basis you want to use, you'd probably have what I would consider to be a more reasonable number due to the fact that we had an intraday spike. This is David Morgan signing out for themorganreport.com.
The U.S. government debt is about to cross $37 trillion. That's not a typo. That's trillion with a T. Tariffs are being used to try and even the playing fields. Global supply chains are shifting. Inflation isn't going away. And the value of your dollar? It's quietly being drained while no one is really talking about this. The truth is, we're living through the early stages of a financial reset, whether anyone wants to admit it or not. And if you're still relying on mainstream headlines or financial advisors who just tell you to write it out, you could be blindsided when things really shift. That's where the Morgan Report comes in. For over 25 years, David Morgan has been helping investors cut through the noise. He tracks what actually drives markets, from precious metals and mining stocks to global debt and monetary policy, and show you how to protect and grow your wealth when the system is under stress. This isn't just about gold and silver. It's about having a clear-eyed view of where things are headed and making sure you're not caught off guard. The Morgan Report gives you real research, honest analysis, and strategies you can act on, even in a world of rising debt, unstable currencies, and economic uncertainty. Go to themorganreport.com today. Download your free report. Get informed, get ahead, and take back control of your financial future. Themorganreport.com, because $37 trillion in debt won't fix itself.